A very good evening, everyone. Welcome to Admiral Markets. My name is Chris, and together with Nanette, we both are going to take a look at how to scale in and out. This is a two-part series, in fact. Next week, Thursday, we will have the second part. And before we dive into today's topic, and we continue with this Admiral Markets webinar, first of all, be aware that this webinar is shown to a global audience, but may not be suitable for everyone. Please take a look at the link here, select your country of residence, and contact an appropriate entity to find out if it is suitable for you and other details and conditions. Also, please be aware that trading for exchange and global financial markets is considered a high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only, and by continuing watching this webinar, you agree with this disclaimer, plus you're aware of the risk involved when trading. All right, thank you so much. So as always, I wanted to let you know that this is hosted and possible through Admiral Markets. And well, if you haven't had time yet, then hopefully tonight you can take a look at MetaTrader 4 Supreme Edition. A lot of extra features that are included, like an easy money management tool, like for instance the correlation matrix and the negative balance protection that Admiral Markets offers, but there's also a very interesting, let's see, the volatility map, the heat map that you can find on the website. So there are a lot of cool things that you can find out with the website, and also with regard to Supreme Edition. There have been recently actually 10 extra features released. For instance, how much time there's left to the bar closes, pivot points, a drawing tool, all kind of tools that you might find interesting. Alrighty. Scaling in. Okay, let me check first of all if the sound is working. I have unfortunately, one person that does not hear me apparently. So would like to check if the sound is okay. All right, thank you so much. All right, so scaling in, basically it's adding new trades on the same instrument. If we're in euro dollar, for instance, and we're adding another euro dollar, that could be scaling in, but it is then in the same direction. So if I'm a euro dollar long and I add another euro dollar long before the first one is closed, I'm scaling in. And if I would do that to the opposite direction, so if I'm in a euro dollar long but I add a short, then I'm hedging. That could be profitable hedging if I'm up in the trade. It could be negative hedging if I'm down in the trade. Most traders, if they do hedging, it's negative. Some try to hedge a profit in the hope that the profitable trade, can go further their direction. But we're not talking about hedging today. It's about scaling in. So that's about the same direction. And if we're scaling out, then we have one trade or two trades open, and we're closing part of those trades, in fact, and we're closing only a position, not the whole position, but just a percentage. It could be half, it could be a quarter, whatever. It doesn't matter. That's scaling out. All right. So an example. Let's take a look at the chart to see an example. For instance, if we see price here turning at this spot, for instance, this was a live trade that I think we discussed on the pound USD. I remember indeed, and that could be one position, for instance, right? And if I would add a position before or after, those could be scale-ins. There could be different reasons. We'll talk about what different reasons there could be for scale-ins, in my opinion at least, and then it's going to talk about his 2 cents in just a while. But if you take positions on multiple spots, right, that's scaling in. It could be even at the same spot, but that would not really, in my opinion, make much sense. Although it's possible if you think that it's easier to manage the trade, for instance, that could be possible to do that. If you take 1% risk on a trade and that's 2 minis, and you think it's easier to put 2 take profits, right? You want to have 2 take profits. Well, then obviously the solution to that could be to split that trade in 2. That would be one way of scaling in. That's not the type of scaling in I'm really talking about here. Technically, that is scaling in, but obviously, in the back of our mind, we know that it's kind of like one trade, but technically it is two trades. So that would be one example, and we could have two TPs. The other scaling in would be at different prices, right? Either here, for instance, at the turn, or at the rejection here could have been one, at the fib could have been one scaling in, for instance. Then after we see a pin bar, then after we see time factor kick in, that was the reason. Then after the break and maybe a continuation. I'm not saying that all of these should be a trade, by the way, but those are potential possibilities to have one trade and maybe add another. All right, so that's something to consider. So all kind of reasons there could be to trade, and we're going to talk about that in a second. Alrighty. Now there are some dangers regarding trading. All right, regarding scaling in, I should say. Sorry. And one of those is from a psychology point of view. Psychology point of view is the fact that we start revenge trading if things go against us. Problem is that if we have scale-ins, it's just less obvious what our position. We might lose track basically of what's going on. If we have too many trades and our maybe our accounting in a way or our managing of the trades is not that accurate, then we might lose track of how much risk is open, what trade belongs to which trading plan, what are we going to do with the trade management. Might become messy, and when it becomes messy, we lose the feeling of control, and that might lead to revenge trading. We might just lose the overview, start taking more trades because we just don't have the sense of where's the border, and before we know it, we are over trading. All right, so that's not good. So we want to have, in any case, we want to have trades that we have, of course, a clear understanding where they are from, why they were taken, what we should do with them. Sounds maybe very basic, but if we have a lot of positions open, and some traders do, you gotta have good it's a good overview. Otherwise, you might lose that, and you get revenge trades. That all leads to emotional reactions, of course, which is only leads to more whipsaws and bigger drawdowns and more dangers regarding the loss of account. What we want to do is always limit those bad days. We actually just want normal losing days. As Paul Tudor Jones, you can see in the picture here, always said, focus on defense. Don't focus too much on offense. The offense will take care of itself if we just make sure that we don't have horrible losing days. Because the problem is that we might have a couple of good winning days, but if we let our guard down and drop the ball on one of those days, even if it's once in a year, right? A bad day, a really bad day where we lose more than our risk management allows, could be devastating. And that's just a very problematic thing with the revenge trading and emotional reactions. We could have consistency 10 minutes straight and earn 500,000, 2,000 euros a month on average, nicely, consistently, but then boom, 1 month we hit a psychological weak point somehow, and instead of losing maybe 200 euros, in the worst case scenario, it's all of a sudden 5,000. If we can avoid those things at least, the very least, then we're going to be at least doing a good job to getting break even. All right. The shift also focuses from cutting losses, because if we have multiple positions, it's difficult to calculate. I mean, you have programs to calculate the average, but what is the average price? But it's difficult to understand, where is that average, and it requires more discipline. It's not as easy to say, okay, I'm going to cut maybe the trade right here. So it shifts the focus away from those losses. Cutting losses short, right, and letting winners run. Risk management, obviously, we need to be aware that if we don't pre-plan it, it's definitely going to be an emotional response to what's going on in the market. It might increase losses, and there's going to be danger of averaging those losses. And, well, Paul Tudor Jones was one of the traders that is definitely not in favor of averaging losses. He has, as you can see in the image, losers average losers, or losing traders average losing positions, in other words. He's definitely not in favor of it. I don't often do it myself, so I'm not a big fan of it either in practical terms. But I do think that if done properly, it's possible. If you want to be safe, like Paul here, Mr. Jones, you might think of not doing it. There are some significant disadvantages, as you can see here. We're adding more risk. There's danger of averaging the losing positions and increasing the losses and getting emotionally involved. So that is definitely some drawdowns. But we're going to talk about some ways to tackle those drawdowns, to tackle those disadvantages, and still be able to do the scaling in. All right. Let's see. Great stuff. Good that the sound is working. And Accu pivot point strategy, the strategy that Ned and I are using, is something that we do not use scaling in with that strategy. No, we typically just take one position and just manage that trade and then exit. And we do trade management. We trail stop it at occasions, that we do a market exit or a TP. So we do those kind of things, but no, not the scaling in. And not even the scaling out, actually. I don't know, maybe Nennet is different, but we can ask him still. So, well, first of all, the beginners obviously should focus on one setup at a time. Gotta really build that experience. I know that we build experience by trading, but we build it not by taking massive amount of trades. Obviously, if you have one demo account that is dedicated just to take freewheel and take as many trades as you want, by all means, go ahead, right? No problem. But if you are a beginning trader and you have one of those accounts, that's great. But you need a second account that's a more serious demo account. You need a serious demo account that you feel has importance. If you attach importance to it, then you can learn to ride the bike with training wheels. Later on, if you think that your results have been doing well and you're satisfied, you can start to trade and add more than one trade at a time. But you need to see consistency with one setup at a time. Once you have a track record, you can go to 2, and then you can move on to a small live account, etc. And open up more trades perhaps, but you need to start off simple. And scaling in and scaling out is really only something that you really want to do with some experience under your belt. It doesn't make sense to focus on too soon. Sure, you can practice that even if you are a beginner, no problem. But on the serious account, as I said, really try to make an account with 1 or 2 trades. Then think about a third, and when that goes well, maybe then think about scaling in. All right. Other things you might want to think about is the fact that when a first position or original position is reduced in risk or is out of risk and you have the position break even or in profit, of course, yes, then it's obviously a bit easier and more logical as well. Certainly the risk is not on the table anymore, so it clears up the potential for another trade in that direction. Why not, right? We got one trade in profit, if there's good reasons technically, of course, or according to your system. Even this, some traders are not a big fan of. They think that it's dangerous. You got one trade, okay, you got it out of risk. Why jump in a new one? So I understand those positions. I can see that as well. To be honest, I don't do that even myself too often. But in theory, I think that if you have good reasons to do it, if you see a pin bar and then after that a breakout, I don't think there's anything wrong with that. All right. And the next point, we want to pre-plan it. We don't want to have this spontaneously done. So you definitely, when you take your first position, before you take your first position, you want to think about the scale in. not take the first position and do the scale-in. Because if you do that, you're allowing yourself to enter a trade at a moment that your head might not be as clear and as focused and as not emotionally controlled as you might like. If you do it beforehand, you have a clear idea when you want to do the scale-in, you're following your plan. If you don't pre-plan it, you're being spontaneous and perhaps emotionally reactive to what's going on. Not good. So you want to pre-plan it. You want to also know what risk you put on what part of the trade. If you're taking the fib bounce, whether you put 50% of the risk on the fib bounce and a quarter on the breakout and another quarter on the second breakout, for instance. Those are things you can play around with, but you got to pre-plan that. You might, some traders put more weight on the first trade and put less on the second. Others do it the right around. They put more weight on less weight on the first one. They kind of like try a small position first and put more risk on the second trade when it's going their way. So for instance, if you're taking a 50% bounce, take a small mini size trade, for instance, right? And then you're up in profit. You might even lock in some profit, for instance, and you take a second position that's 2 minis instead of 1 at the breakout. And that profit you're locking in from the mini might cover some of the risk of the second trade with 2 minis, right? Stuff like that. Especially fib traders, I talked about it already, can take that as well. You might decide, okay, I'll take some risk at the 50 fib and some at the 78.6 fib. If I split the risk on those two fibs, the lot size, and I split the risk equally, both 0.25%, and the lot size for the 78.6 fib, the deeper fib is going to be higher. I'm going to have a higher lot size. Stop loss is smaller. Alrighty, and we end with a quote saying, at the end of the day, the most important thing is how good are you at risk control. Ultimately, any of these ideas still boils down to risk, and technicals, of course, choosing good moments as well. Alrighty, so let's talk a bit about where and when these ideas can be possible. Talked about some reasons why to take scale-ins already. So let's talk a bit about these fibs. For instance, we see a 38.2 fib here. We have a green circle and a 61.8 fib there, right? Could be very good reasons to scale in at these fibs because we're in an uptrend channel as well. And if you're a bit nervous for placing in a pending order at the 61.8 fib because you think that the currency might turn earlier and you might miss the trade, scaling in could be an option, right? Put half the risk on 38.2 fib, let's say 0.25% at 0.25% to the 61.8. That could be one way of solving it. And then you got a bigger lot size, the 61.8, and the trade goes our way, and that's great. And if the trade doesn't go our way, then we have a loss on 2 trades, but of course the total is 0.5%. So if you take 0.5% on 1 or 2 fibs, in most cases does not matter. There's one exception. If price does bounce off the 38.2 fib and not the 61.8, then we only have half of that risk in the trade. So we can only make half the profit. So, sometimes you're going to have maybe smaller wins and bigger losses sometimes, right? So you got to make sure that you choose good fibs that have a good chance of being filled. It's debatable if it's worth it here. But if you like fibs, it's something you can think about. If you have doubts about 2-3 levels, you might want to think about splitting that risk. And, just be aware that you want to take fibs that have a good chance of being filled. And you want to use other tools and confluences to make that judgment. That's one way. The other way could be to take one position at a fib. Let's say we take 0.25% risk at the 61.8 fib. But then we're taking one position at a fib, but the other position after price shows a turnaround at the fib, right? So we see price One pending order could be at the 61.8 fib, and then the second position could be once price action is showing that it's bouncing. That could be, and how does it do it? Well, it could be an engulfing twin. There could be momentum on the lower time frame. There could be bullish candles, 2 or 3 in a row. That's all showing that price is respecting that fib. That could be then after we see the confirmation, the second position, or it could be a breakout, right? In this case, we don't really have a breakout, maybe of this trend line like that. That could be a second one, or even this breakout here. That could be a second one, right? Then we have a position that's up in profit by this much, right? Which means that if we take the breakout somewhere in here, we can move the stop loss all the way here, lock in this profit on the first position, put the second position stop loss there. So basically the profit of the first position is covering the loss of the second position breakout. And you got two positions going the same, going into our way, into our favor, but without the risk. Okay, you don't have that profit of the first trade anymore, but you don't have any risk either. But you got double the size maybe, right? That could be another way of doing that. So basically, those are a couple of ideas. Let's see here as well. We got fibs basically, and then again, potential for breakouts here for adding bounces as well. So any of these bounce and breakouts could be ways to scale in basically. Alrighty. Another option is using the concept of break pullback continuation. Nena talks about it often as well. This is an example of the Australian US dollar, AUD/USD, and basically saw price bounce off the 61.8 fib, which is also the inverse head and shoulders here. And I talked about this potential setup live, or not live, it was in a video about 1.5 weeks ago. And yeah, so someone takes the 61.8 fib, that could be one trade, the initial trade, and the breakout could be the second, right? And perhaps even scale in on a lower time frame as it makes a slight pullback. So there could be 2-3 positions here on the way to the target. And the stop loss will be trailed. So each time, the first position is making more profit, the second position is making a bit of profit, the third is maybe in a small loss, and eventually also goes to profit, right? And this is a good example, obviously. But this is how you can use break. And once again, what is a break? Well, this is the first break, obviously, here, right? That's the first break. This is the pullback, right? And then this is the continuation on a larger time frame. But if we zoom in to the continuation part, then within that continuation part, there's again a break, pullback, continuation within that continuation. So the cool thing is you got multiple of these BPCs going on at all levels. So that's why you can use multiple time frames to use scaling. One way could be, okay, I'm going to take a swing trade at the 61.8 fib on a 4-hour chart, and I'll be trading on a 15-minute chart somewhere in here because then it's a breakout territory, right? And all of these time frames are you're going to see multiple BBCs going on multiple time frames. All right, now if that might seem confusing, I hope not. I did my best, but no panic. We're going to take a look at some live charts. Do you have any questions that you might want to ask at this moment? Next week, we're going to take a look at scaling out. At least that's how I have it planned. I think that then at 2, but we'll find out soon. I wanted to talk about the pound USD, actually, and how that had some interesting potential for scale-ins, in fact, and perhaps euro dollar too. Any questions? Let me know. First, actually, thing I wanted to say is the downtrend here was, of course, very strong. So when price turned here, breakouts, pullbacks, breakouts, when the trend is really strong, there could be a lot of breaks, pullbacks, and continuations. And this down channel had A lot of them had a lot of moments where price was pulling back, breaking, pulling back, continuing, bear flag, continuing, pull back, continuing, pull back, continuing, pull back, continuing. Now I'm not saying that everyone should be traded, but you get my idea. Beautiful trend gives beautiful opportunities as well, and the pound USD had that wonderfully. Now what happened? Eventually we had triple divergence. In the live webinar we said, well, it's gone up, the pound is going to make a bigger retracement at one point. And we saw this impulse. Well, that was certainly another clue that the moment was come. So the break of that channel could have been the first breakout to the upside, in my opinion, right? But the pullback after this momentum occurred, the chances of a bigger correction were really high. So the first reversal trade, I think, that made the most sense, at least, was off this fib and this fib. And even if it would have gone lower, but it didn't. Right? That could have been the first initial reversal trade. But a second could have been the breakout above this, right? Because we see a bull flag. We see momentum. We see a break out of the downtrend channel. We see tons of divergence to the downside. So a scale-in, yes, could have been possible. We got one position to 61.8, one scale-in. Depending where our target is and where our scale-out is, right, there could have been even a second attempt here. Now that didn't go too well, as we can see, because we got one more downside. So I'm not going to talk about profits, just talk about scale-ins at the moment. But one of the next trades, in fact, was somewhere else, was here, because I was talking about that in the live video as well, was the fact that this will probably get retraced and bounce too. So in that week, I was talking about the bounce here, and yes, the bounce here and here are these fibs, and the continuation up to the target. So that happened as well. Then we finished a zigzag, and therefore an entire correction like this, and we bounced actually off the 78.6 fib. Now that's not too important in this case. Let's ignore the 78.6 fib bounce. But again, scaling could have been upon the break here. Perhaps that was maybe not the most easiest trade, because I was also looking for a rejection at resistance. So that was only a small trade. Probably not. So let's speed forward. Those I don't think was much to trade. But here, the break certainly of the triangle, right, could have been one entry right there, either at the bouncing spot. That was a difficult trade as well. But the 50 fib here, I think, was definitely something we talked about clearly. The fact that it can bounce off of this fourth wave like that, that's something I remember very clearly talking in the webinar, and the breakout. So that could have been the first position, and here could have been the scale-in, right? Such as here was the first trade, and here was the first trade. Here was the first trade, and let's see, I think those were two trades right there. So often enough, I think that if you're looking at scale-ins, probably a second scale-in is already a lot, I would say. I'm not saying a third scaling is possible, but then you're probably looking at 5 and 15-minute charts, just because of the fact that before you get the chance to add a third trade, you know, the price has moved already quite a decent amount our way. So the chances eventually of price going against our positions is increasing. I would tend to think that, you know, the third scaling is definitely possible, but you got to have a good trend. This is a reversal trade. So with reversals, I would stick to 1 or 2 at the very max, because it's just the chances of price just running into resistance or support and having some struggles is problematic. All right. But if it's a trending environment, because this is still a reversal territory, mind you, all of it is reversal because they're getting deep pullbacks, right? Like that. But if it's a trend, it's different. Trend is way different. Look at that. Especially if it's strong like this, big momentum. Well, if we identify price action parts with momentum that are really pushing like this, we can think about the potential for scaling in a bit more. Or obviously just taking trades and closing, and then re-entering and closing. That's possible too. It doesn't have to be scale-ins, but If you want to try to catch one position, one original position here that really goes for a large win, right? Just leave that trade on, for instance, and scale-ins, enter here, and then you exit those scale-ins a bit quicker. That's all very logical, right? And when the trend, but in any case, there is more potential for scale-ins when the trend is just larger because price goes our way quicker and it keeps pushing, pushing, pushing. And I'll show you how that chart looked actually on the daily chart. Look at that. That's the type of momentum. So yeah, then there is, when you get that moment, it is definitely has more opportunity. And how do you know that price is going to make this momentum? You might wonder, and I just deleted the pound USD, so we get that back. And the measuring moment was actually the bottom of this downtrend channel. I was saying, if you maybe listen to the recap videos that I have sometimes or webinars, that this channel is very, very shallow, right? This channel here, this part. It needs to break to the bottom if this downtrend is going to accelerate and show some muscle. And it did. It broke, pushed through that support level right here. Now, this candle I don't think was enough, but once we got a full candle below it, especially two candles like this, that was a clear bottom break, and we could be feeling a bit more comfortable with scale-ins in this case. Multiple scale-ins perhaps, right? That's my my view. Obviously, if you're trading reversals, once again, it's difficult because you got short corrections like this. Let's take a look at your dollar, for instance. Here, look at this, the fall from resistance. Three-wave down, where do you scale in? If you take one position here, where are you going to scale in? Here, maybe here. Well, maybe, but very risky, so close to this position. There's no space. There is no wide open space, not at all. There's some space, only enough for one position. Not a second, right? So there could be one trade to the downside. Then we're talking about the fact the price could bounce off the bottom, right, and head back to resistance. So that could have been one scale. That could have been one trade. Scale in, well, maybe a small consolidation here, maybe, but there's not much space. Once again, the resistance is right here. So probably not. Probably only good for one trade right here. But we did talk about the fact that if there's a triangle here, there could be a small space here. That could have been a second scale in right there at the triangle break. And obviously earlier today as well, when we had a wave 4 triangle, and it could have been the third position perhaps. If one wants to hang in those trades, there's nothing wrong with grabbing profit either. All right, but if you're looking to scale in, that could be one way as well. Now we're all the way up here. Is this a good moment to scale in? My opinion, not. Too soon. In any case, I think that we're probably due for some retracement. So no, it's I don't think a good moment to scale in. If it were a very strong trend to the upside, yes, maybe yes, but I don't think the euro dollar isn't a strong trend to the upside. I do think that obviously we're having a good correction like this, as expected. Price is breaking through this resistance. I was talking about my bias to the upside on the euro dollar, but doesn't mean that I think that the euro dollar is in a trend. No, it's still in this range. So yeah, there was maybe a good trade here and here and here, but not yet at the moment at least. If we see a triangle, perhaps one more up to this target. Yes, maybe a fourth. But only if there's a triangle and continuation. And then 114, I think, is a target. A lot of tops in here, a lot of resistances, minus 61.8 target, etc. All right, got one question on the dollar yen. Let's see. 29 main till 2nd February. I'm not sure, Alexa, what the question is. If you could maybe elaborate. 29 January till 2nd February. Okay, let's see. Oh, this fall. Yeah, the fall was indeed talking about the fact that this is going into resistance zone, at least um, the chance that there could be a turning spot. And indeed, slowly but surely, boom. And yeah, there could have been some scale-ins here. Obviously, could have been a position perhaps somewhere around this turn here. And earlier today, again, same like the euro dollar, but then to the opposite side. All right. Do you track related commodities when determining trend to assist scaling in? Personally, I don't look at I mean, when I look at the majors, I just look at the technicals of that major. But yeah, if it's euro odd, it won't. I don't think hurt to take a look at the odd USD and euro USD, for instance. Might be good to take a look at that. I'm not personally a very big scale-in trader, so it's not something I do regularly. I like to just take one position and that's it. That may be a bit more conservative, but it's something that I think once again makes sense if you are careful, cautious, do it with experience. Uh, I can see that it might have value there. That's what I mean. And you want to do that at smart spots. So I'm trying to show you what I think could be smart spots on the chart. Using the market structure to find moments that make sense. Because if we just start scaling it at kind of points that are maybe at random or not that in sync with market structure, I think that could be suboptimal. MA settings is 21 EMA close and 144 EMA close. All right, but that is basically my 2 cents. Scaling out, we're going to talk about next week, and that's something that I do more often. So a bit more than scaling in, at least. So we can talk about that. Let me pass it over to Nedit now.
Thank you, Chris. So that was Chris and his view on scaling in. So today, I will repeat a bit about our scaling in and how we do it, and I will also show you some charts to take a better look. And I really think that this is a good subject for a thought, because you definitely need to think about scaling in, especially if you do it on a swing chart. Now the thing is, Alex is asking, I think, or Alex, or who's asking about AccuPivot points. Are we making any scaling ins with AccuPivot points? Basically, AccuPivots and all, guys, it doesn't matter, AccuPivots or other intraday systems, they're not so useful for scaling in. The only thing is, for example, you call it scaling in a pyramiding. I will explain it. But the thing is that it's more like adding to a winning position as a breakout trade. So it's a bit different. You scale in usually if you aim, for example, for a swing trade, or you can do it if your account is a bit bigger. It's hard to scale in if you're trading from $100, $200, $500 account. You need to do with micro lots, and it's not that simple. The thing is, you need to wait. You might also trade with your risk margin, a complete risk margin within a single trade. So it's not that recommended. So it's better if you go with swing trades and then add to your positions. Now this is how I do it. I also repeated it. I will repeat it again. Let's take this example. We want to take a trade of 0.0 lots, okay, 0.4 lots. Now this is our potential trade. Stop loss is 36.30. Our entry is 36.80. Our POC zone is 36.80 to 36.50. Okay, for example. And we have a stop. This is our stop, and this is our target. So 3680 to 3650 our POC zone, 3630 is our stop loss, and our target is 3770. Okay, so let's also illustrate it. Let's say, so this is our, we call it POC zone. For all of you who are still wondering what POC is, this is POC zone, our buffer zone for entry. This is just an example. So I'm not talking about any particular pair. I'm just talking from a perspective of a potential trade, and it doesn't matter which pair. So just an example, for instance. So this is what we see, and now we want to take a price gets here, and instead of opening full 0.4 lots, we will open only 0.2. The price gets deeper in the zone, we add 0.1. It gets deeper in the zone, we add 3650. So now we have we have three positions with total of 0.4 lots. But our stop loss is intact. The same stop loss applies for all of these trades. Why? Because we have defined our zone. Okay, this is the zone where we expect the price to bounce. So we have defined the zone, we placed our stop loss, we don't move it. And we, let's say, aim for 3770. Now, if the price goes into your favor, you would be making $180 for the first position, $110 for the second position, $120 for the third. It's total of 410, guys. Okay, it's total of 410. Now, if you had entered 0.4 full potential, so this is, for example, the only trade you made with 0.4, you would have made 360, which is $50 less than if you divided your trades like this. So that is why the profit always goes exponentially up if you scale in. So let's say if a price hits stop loss. So this was your initial entry. This is add in, this is add in. So this is all scaling in, but the price instead of profit hit a stop loss. So if the price goes against you and it hits a stop loss, you would have lost $150 instead of $200. That means that, and that explains how the losses are going exponentially down if you scale in. Okay? Now, what is so-called pyramiding, or it's a pyramid? The thing is, it's calling adding to a profitable position. Okay? This is, guys, make a distinction. This is so-called adding into retracements. Okay? So it's called adding into retracements. If you do it like this, you would be doing so-called adding into profitable positions. Okay, so it's called adding into profitable positions. And the thing is, if you want to add to profitable position, you need to be prepared for a bigger swing. That is the most profitable advice I could give you. You need to have a swing, really a good swing, because you will be adding into your profits, not into retracements. Adding into profits means buying resistance or selling supports with occasional money management in between. So this is, for example, you want to enter at 34.50, aiming for 38. Your initial stop is at 33.00. Yeah, mostly for breakouts, Carolyn. I personally don't like to do it. One of the reasons why I don't do it is I mostly trade during the day. And the only exception is session recap trades, where I can hold the trade for a day, maybe, or two maximum, not more than that. But I don't do scaling in this way, because how I see, I need to be honest, the price has been violent. The price has been violent. No, it's not stuck. I don't move the slide. And sometimes if you do this, you might end up losing your profits. So I will, okay, Caroline closed his trade. Well, okay. I will explain on live chart, guys, so pay attention. So price goes 100 pips in your favor, and you enter here, and you add 0.5, for example. Now the first position, this was your first position. Instead of initial stop, it was moved to break even. And now for second position, your stop is at 34.50. So your risk is actually the same. Now you probably think, what's the point in this? Well, the point is only if you want to make a swing trade. So for every 5 to 100 pips, you can add to profit hoping that the price will touch your TP. Well, my experience says that it could have been possible something like 7-8 years ago. Today, it's possible only if you trade on higher time frames. And I particularly don't like trading on weekly. I never trade weekly time frames. One candle is 7 days. So my advice is better stick to our retracement than to this way. So very often, if the price is violent, it will collect your stops and bye-bye. Your trade is off. So that is why I particularly don't like to do it. Okay? And I really prefer retracements. Ilya is saying hi. Yes, hi, and Alexa also. Question is, are session recaps related to AQ pivots? No, Alexa. Session recaps are only related to Camarilla MACD. Now, okay, I will show you the real chart. So scaling out. First, let's talk just a bit about scaling out, because Chris and I will have a part 2 webinar. I will just give you a few examples what scaling out is, because I already promised you that I will explain scaling out. Scaling out is removing the part of your position. Alexa was commenting 20 minutes ago that some brokers allow for scaling out. Of course, most of European brokers allow it. Admiral Markets, of course, allow it. So this is the example. Entry is 36.80, stop loss 36.50, target 37.50, you enter with 0.5 lots. Let's say price hits resistance at 37.2, you can close 0.2, keeping 0.3 running. At 37.2, you close 0.2, keeping 0.1 running, and effectively giving out the money to the market. So scaling out is just a partial close into the market. Due to first in, first out, or so-called FIFO rule, US citizens are prohibited from closing their position this way. So this does not apply to US traders. So if any of you comes from US, unfortunately, guys, for you, regulations are strict. You need to first close your position which you opened the first. It's called first in, first out, or FIFO rule. Okay? So don't worry about it. Ilya is saying, could you repeat the slides at the end of the webinar? Ilya, unfortunately, Chris, I think he's already gone, so I'm not sure that he can repeat the slides. I can repeat my slides, but don't worry. This webinar is being recorded and it will be uploaded tomorrow, so you will be able to watch it again. So don't worry. So guys, any of you, if you come from US, well, the only option is if you want to trade with European brokers, Admiral Markets, you can do it if you have a double citizenship, okay, 2 passports. So then you can trade it. But if you have only US citizenship, you won't be able to trade with European brokers. I say regulations are very strict. So this is what I do from time to time. And this is when I say, guys, on my Twitter, try to scale out. That is how you effectively manage your trade. So let's say that you made 50 pips and you are not sure that the price will go down or up. So you just scale out. Let's say you close 50% of your position and put the rest to break even. That is how we usually deal with scaling out. Okay? This is also example. Close 0.2, 0.2, 0.1. And if you enter at 36.80 and close it at 37.50, you would have made $350. Okay, so the only problem with this is, as I say, you might be giving the money to the market, and it's still viable more for swing trades. For example, session recap trades, those are very reliable, but not for intraday trades. So it's better for this. So now I will show you now a real-time chart and the example how it can look like. So this is it, guys. Let's say this is a potential trade at this time. So we are talking, for example, now this is the present, okay? So you see that dollar CAD is in huge uptrend. It broke through previous double top and it's going up. So at this time you see that retracement has been formed. You decide, because you see that the trend is strong, you decide to enter at 23.6, but your stop loss is here. So the price goes down and here you can enter or here you can add. But if you decide to enter here and define your stop loss here, that means that you still have the buffer zone for potential scaling ins. And that's actually a good thing because you already defined your overall risk. Now, it doesn't matter that your potential risk is it's huge. Okay, this is daily chart. Okay, daily chart. It doesn't matter. 570 pip of a stop loss. Well, some traders trade on daily charts. So you decide that your stop loss is, let's say, 600 pips, just slightly below this line. So you go with 1% of a risk. So in that 1% of risk, you should be able to divide your entries here. And if you did it correctly, you would make really, see, potentially 1,000 pips of profit, a bit more. So that is how you actually, it doesn't matter the time frame. It just matters that it's the rule. How you scale in is the rule. You can do it on 1 minute if you want. This is dollar Swissy, and I don't know which trend line. If you talk about this bottom here, 4-hour time frame, you see 4-hour is now is going down. But if you guys compare it to this low here, it's getting close to 78.6. So 78.6 could probably be a buy spot for dollar Swissy, because obviously the price is gravitating towards it. And still, this could be a good buying spot for dollar Swissy and a close for euro dollar, respectively. And now, how would we manage, for example, our long trade? So let's find 1-hour chart or something which had a trend. So let's say that this was, okay, let's remove this. And this is 1-hour chart. First of all, guys, you need to have a trend. You should never ever do this if the price is not showing a trend. You might be stuck in losing trades. So you don't do it. So you need to spot a trend very clearly here. Left head, right shoulder. We have a trend line here, so-called neckline. And at this spot, we had breakout, retest, continuation. So now from this spot on, you can say, okay, this is uptrend. Place a fib in this uptrend here. And you see, you could have made your stop loss here and two potential entries at 23.6 and 38.2. Okay? So that is how you do it. Next swing, okay? Next swing is here. Here, let's say that you want to place your stop loss here, 5 pips below the line, you see, and you define your zone as this. So you open a trade here, you open a second trade here, your stop loss is not moved, and eventually you would be in profit. as I say, you should do this only if you see a strong trend. And mostly it's much better to use it on swing time frame, not on intraday time frames. Okay? An example for scaling out. So you want to scale out. You need to define your important levels of support and resistance. And you can do it by watching pivot points, for example, Camarilla pivot, and like this. Okay? Like this. So you want to take a profit somewhere. Let's say that you have opened a trade here. And we will use historical Camarilla. Okay, guys, like this. So let's say that we are here in the past. So you want to close your trade. First position, or so-called scaling out, is close here. So you scale out around this level. Okay, when price reaches next level, you can completely close your trade or take a whole profit. How traders do it usually, when price is very close to resistance, they scale out and put the rest to break even. So let's say that you have 0.5 lots running. You will close 0.3 lots here and move your stop loss to break even. So you are effectively riding a free ride towards upper levels. So that is how traders mostly do it. Now, guys, if you have any questions, this was just a small intro to scaling out. We will delve deeper in on our next webinar. If you have any questions, ask me. If anything is not clear, of course, go ahead and ask me again. And pay attention also to our Sunday blog. I will be publishing something very interesting about brokers. So you will see something which could be interesting for you. Okay, guys, so that's it. I don't see anything. Lo is saying, thanks for uploading training in lower time frames, part 1. Thanks for the webinar, Chris and Nenad. Yes, of course, Nat, Lo. One question from Ilya. Yeah, Ilya, go on. You sent me an email about 2 indicators. I will look at it and I will send you. Maybe if you can send me right now. So after I finish with webinar, I will look at it and I will reply. If you just forward me right now, it would be great. Thank you, and you're welcome. So that's it, guys. A small intro. Now you know how to basically scale out. Yes, Ilya, that is my Gmail. Yeah, Torrential FX. And again, you want to do that only in strong trends, and mostly like breakouts. If you do it on intraday time frames. Okay, I don't see any questions, so thank you for listening to us. And as always, we'll be here with you soon, guys, on Monday and next week. Cheers and trade safe.